Welcome back, everyone. It's Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today's topic comes from Mary, who says, I know that I need to invest for the future, but really don't know where to start. My job does not offer a retirement plan. Can you give tips for how a complete novice can start investing without taking a lot of risk? Mary, I really appreciate your question. I think investing can initially seem complicated and risky, but I promise it is very easy to start slowly and without taking too much risk. This podcast will review the steps anyone can take to begin investing based on your financial situation and goals. Welcome back. Thanks for joining me on episode 863. I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of the Money Stack newsletter, and host of Money Girl with over 43 million downloads. And before we get started, if you're getting value from the free content that we love creating here, consider submitting a 5-star rating or a review on Apple Podcasts, Spotify, or wherever you're listening. If you have a money question you'd like me to cover on a future show, you can leave it on our voicemail at 302-364-0308. You can also send me an email and sign up for the free Money Stack newsletter when you visit lauradadams.com. Mary, I want to start out answering your question by reviewing the difference between investing and saving. I think many novice investors need clarification about the difference. So before you do anything with your money, you want to master this concept. So saving is putting money into a safe account, like an FDIC-insured savings, so that you preserve that money. That's really critical for your short-term goals, like building an emergency fund, or maybe you want to buy a car within a year or two. You want that cash reserve to be there when you need it for your planned purchases and any unexpected hardships, like losing a job or having an unexpected medical bill. And investing is very different. Investing is for long-term goals that you want to achieve in at least 3 or more years into the future. Now, these goals could be buying a home. It could be paying for a young child's college, and of course, retiring. You put money into assets or financial instruments like real estate or index funds, expecting future growth. Generally, investing is not appropriate for short-term goals because market values can fluctuate within short periods. They can fluctuate wildly depending on the investment. And investing requires some risk, okay? So that's the big difference between saving and investing. With saving, you're keeping your money safe, but with investing, you are putting it at some risk. But without risk, you are not likely to earn enough growth to beat inflation and achieve significant financial goals like retiring. And a good rule of thumb is to invest a minimum of 10 to 15% of your gross income annually. Now, while it's wise to begin investing as soon as possible, ensure that you have enough savings first, okay? So a good target is 3 to 6 months worth of your living expenses. So these are things you have to have: housing, food, utilities, debt payments. For example, if your living expenses total $4,000 monthly, make a goal to keep $12,000 in savings. And I know it might take a while to get that amount of savings, but if you can only set aside 1 month of living expenses in a savings account, that's better than nothing. You know, at that point, when you've got some amount of savings, you're ready to begin investing once you've got a little bit of a cash reserve to keep you safe. And remember, you can always contribute to both a savings account and an investing account simultaneously when you're ready to invest. So when the time is right for you to become an investor, I'm going to go through 6 tips for reducing risk and earning more as a novice investor. So number 1 is to purchase a diversified investment portfolio. And this sounds complicated, but it's actually really easy to do. And this is so important because buying and selling individual securities, like an individual stock, is not wise for the average investor. And I think a lot of investors think that's what investing is. They think it's picking stocks. It is not picking stocks. It's important to be diversified because No one can predict whether the value of an individual security will go up or down. Picking one is kind of like gambling. So a better strategy is investing in one or more diversified funds, which bundle investments, making them convenient to purchase. So investment funds are diversified because they're made up of hundreds or even thousands of underlying securities. These could be stocks, bonds, currencies, real estate. There are a lot of things that funds can own. Diversifying allows you to earn higher average returns while reducing risk. And that's because if some of the securities within a fund lose value, some are going to increase, and that will minimize potential losses. Since the 1920s, the historical average return of the stock market has been approximately 10%. So if you have decades to go before you retire or decades before you need to spend the money that you're investing, consider investing a large percentage of your portfolio in stock funds, such as index funds. Stock prices fluctuate in the short term, but they will likely increase over the long term. And that's going to give you a great return. For instance, even if you only earned an average of 7% on your investments, you'd have a nest egg worth over $1 million after investing $400 a month for 40 years. So this is what I do. I purchase a diversified investment portfolio using a variety of funds. And I'll talk more about funds in a moment. So the second tip is to understand investment funds. Every novice investor should be familiar with different types and categories of funds. Here are a few you're going to see on a typical investing account menu. Maybe mutual funds will be on the menu. These are a collection of assets that are managed by a fund professional. Buying and selling shares in a mutual fund are restricted to the end of the trading day when the fund's net asset value gets calculated. And that's a little different from how an exchange-traded fund or ETF works. ETFs are similar to mutual funds in that they are a basket of assets. However, they trade like an individual stock, meaning you can buy or sell ETF shares throughout the day and should expect price fluctuations. You'll also see index funds. I mentioned these. These are mutual funds that usually come with low fees and may be made up of thousands of underlying investments. Index funds aim to match or even outperform a specific index, such as the Standard & Poor's 500 index or the Dow Jones Industrial Average. And you might see target date funds. These are also mutual funds that automatically reset the mix of assets in their portfolio according to your set time frame, such as when you plan to retire. Mary, the main thing to understand is that funds come with different fees, and these are known as an expense ratio. For example, a 1% expense ratio means that 1% of the fund's assets is used to pay yearly expenses, like its management and advertising costs. Generally, choosing low-cost funds, such as ETFs and index funds, is best to avoid unnecessary costs that diminish your returns. All right, the third tip is to purchase funds inside a workplace retirement account. When you purchase investments inside a workplace retirement account, like a 401k or a 403b, you accumulate wealth for retirement and get some pretty nice money-saving tax benefits. However, if you're like Mary and don't have one, it's not a big deal. You have access to other terrific tax-advantaged options that I'll cover. Most employers offer traditional and Roth accounts, which have different rules and advantages. Traditional retirement accounts allow you to defer tax until you take withdrawals in the future. Roth retirement accounts require you to pay tax on your contributions, but allow tax-free withdrawals in retirement. Note that you can choose either type no matter how much you earn. Workplace retirement accounts are even more valuable if your employer pays matching funds. For example, your employer may match your contributions to a limit, such as 3% of your salary. So let's say you earn $60,000 and contribute $1,800, that's 3% of your salary per year. In that case, your employer would add $1,800 annually or $150 a month to your retirement account. So that's pretty nice. But even if you don't get employer matching, it's still wise to max out your retirement account at work every year. For 2024, you can contribute up to $23,000 or $30,500 if you're over 50. Your workplace retirement plan contributions get automatically deducted from your pay, and that makes it really easy to invest regularly. It just kind of happens in the background without you having to think about it. And if you leave your job, you can transfer your vested balance into an IRA by doing a tax-free rollover. And we'll talk about IRAs next. So the fourth tip is to purchase funds inside an individual retirement account or IRA. So if your employer does not offer a retirement plan, or let's say you're self-employed or a stay-at-home spouse, you can invest using a retirement account as well. Everyone with earned income qualifies for a traditional IRA. You make pre-tax contributions and defer taxes until you make withdrawals in retirement. There are no income limits to qualify. And if you're married and you file taxes jointly, but let's say you have no income but your spouse does, you can invest based on your spouse's income. For 2024, you can contribute up to $7,000 or $8,000 if you're over 50 to a traditional IRA. And the annual contribution limit is the same for a Roth IRA. However, a Roth IRA has a qualifying income limit. And for 2024, you have to earn less than $161,000 as an individual taxpayer or under $240,000 as a married couple filing jointly to qualify to make Roth IRA contributions. With a Roth IRA, you pay tax on your contributions, but get to make tax-free withdrawals in retirement. And in general, using a Roth makes sense if you believe your taxes in retirement will be higher than they are now. Now, Mary did not mention her income, but if she earns less than the Roth IRA income limits that I just mentioned, that's where I'd recommend she invest. It's easy to open up an account and set up regular contributions using a robo-investing platform like Betterment. A robo-advisor manages your portfolio automatically based on features you select, like your stated risk tolerance, age, and goals. Basically, it's an algorithm recommending a diversified portfolio, typically a mix of 5 to 10 exchange-traded funds. And because trading is automated, robo-advising platforms usually charge low fees, and they're excellent choices for new or experienced investors. That's where I've had my money for decades, and I've been super impressed with all the features they offer. All right, the fifth tip is ignore what you can't control as an investor. Wise investors stay focused on building wealth over the long term using a buy and hold strategy. What happens in the financial markets daily only matters if you have to liquidate your investments during the same period. In other words, you should ignore media hype and never make rash decisions, such as selling your investments when their value drops. Your goal should be to get investment growth over decades, not month to month or even year to year. So the idea is to set an investment strategy like investing 10 or 15% of your gross income and sticking to a schedule, month after month, just being regular and boring with your investments. It is what is going to win in the end. And the sixth tip is to get professional investment advice when needed. Mary, if you need help choosing investments, seek advice from your investment platform. Even robo-investing companies like Betterment have human advisors to guide you through opening your account and selecting suitable investments based on your goals. But they make it really easy. Once your account is open, it will guide you through the process of understanding what your goals and risk tolerance is and helping you choose the investments. It could not be easier. Mary, I hope that's been helpful and will give you some direction. Again, it's opening a Roth IRA, choosing diversified low-fee funds, and investing regularly over the long term. Before we go, here's a quick reminder to subscribe to The Money Stack. It's my weekly newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or support the show as a paid member and get access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. Steve Rickyberg audio engineers the show. Brandon Gaches is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Davina Tomlin is our marketing and publicity associate.